The Bulls versus the Bears. Get in the game. www.tackletrading.com.
Hello everybody, this is Coach D with TackleTrading.com here to give you a market update and a recap for today. Now, when I'm walking through the market with this particular setup, I thought I'd take an opportunity here to teach you all a technical strategy for identifying market reversals using some indicators to kind of measure pressure, if you will, on the buying and selling. Now, this is, by no means a absolutely 100% accurate system, but it's highly effective, and it's really based off of the what's called the revision to the mean. So what I'm going to show you here is a chart with two different styles of indicators on it. One is the Bollinger Bands. And the Bollinger Bands I've applied to the chart. This is what's called an envelope. So what an envelope is, an envelope indicator, what it has is it measures that price data. So you can kind of look in here, you can see the daily candlesticks as the price moves. You can see where they're, move down, 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 then they start moving back up. And it's actually measuring, that price action, and it's using a 20 period moving average in this particular case. And it's usually an exponential moving average. And then what it measures is it takes that moving average and it measures two deviations in price up and or two deviations in price down. So it was where the price was in here, and it says, well, based off of where it was here, two deviations up is here, boom, and two deviations down is here. And then as the price action kind of consolidated in here and it slowed down, meaning that the data was less volatile, it didn't quite move, here it moved a lot, and here it's not moving as much. And so the bands actually say, well, based off of the current movement, two deviations up is just here, and two deviations down is just here. So it's kind of giving you, say, based off of where it's trading, what deviation it would be. And so when it gets more volatile, the bands tend to expand and the distance between them gets wider. And when it gets less volatile, they pinch in. The bands will get, pinch in when prices are actually kind of quieting down. Now, what we would look for in this is the probability of revision to the mean. So if the stock starts to run and it starts trading and hitting and riding or poking outside of the top of that band, what we would look for is down here on an oscillating indicator, a measurement of it being overextended. And we look for that overextended and overextended. And this little indicator, let me stretch it up here, is again, oscillating indicator. And what it does is it's measuring around a center metric, and it's kind of trying to tell us it's tracking the closing price currently over 10 days. I've got it tracking 10 days. And that basically is a real simple indicator. You can see three numbers over here. You can see the three numbers are 10, 70, and 30. 10 is the number of days. 70 is 70% on the top of the range. 30 is 30% on the bottom of the range. So it's saying, well, based off of where it's been trading for the past 10 days, this data is in the top of those back 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. In fact, it's in the top 30%. It's in the top, 90%, 80%. It's up in that range where anytime it gets over 70, it's in the top 30% of data. And if anytime it dips down below 30 here, it's in the bottom 30% of the data. And so, the majority of the data is supposed to occur in here, where you got, 40% of the data on the inside, and you got 30% on the outside and 30% on the outside. Now, you can change those levels, but they're set here with 70 and 30 because that's kind of what typical movement would tell us when it's overextended. It's gone up and it's traded, up in the top 30% of its trading range, and so it's going to have a high probability of reverting back to the mean and seeing the price actions come back in. So what we look for is the combination of price outside the band and the indicator measuring oversold. Boom. And what that tells us is, well, it was overextended, and then it put in a slightly higher low, and the indicator put in a slightly higher low. Let me erase that so you can see that. You can see the indicator put in a higher low. That's called oscillator divergence. So anytime you see a bottom measure here and then higher, well, even though the price is still moving down, it's measuring that indicator divergence is measuring a slowing momentum condition. And here the price action, this is kind of really interesting. You can see where the pivot went down hard, boom, and then that measured hard on the Richter scale down here, so to speak. And then the next one down, it hit, and it measured higher, and then the last one down, it was still higher, kind of higher still. So it kind of moved in that opposite direction, even though it was making new lows, the oscillator, and this will happen with all oscillating indicators whenever you get that slowing momentum pattern. So we would look for and kind of say, well, is it above the mean, is it below the mean? Is it overextended to the top, or is it overextended to the bottom? So if it's kind of in the middle, we could expect prices to continue. So if we were to say, okay, here it is measuring in the middle, and we could expect prices to continue down, and if prices continue down and get to the extreme, we now say, well, now prices are down in extreme, and we'd be willing to say, a bet that it reverts to the mean, and it gets a little overextended. This does it to the upside. Again, it runs up, 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 and it's trading really high, and it says, yeah, you're overextended based off of the 10-day average. And there's a high probability of revision to the mean. You'll see a little oscillator divergence. You can even see a head and shoulders here. This one's interesting. You can see a head and shoulders pattern here and here. And if you would actually probably change those chart patterns intraday, you might actually see that, because it just kind of picks up on those subtleties of the price action changing. So oscillator divergence poking outside the Bollinger Band, and we can do it on any time frame. So right now it's on a 30-minute time frame. Well, in the context of a daily time frame, let's go change that to, let's go hit 6 months. Let's go here, boom, pointer. There we go, time frame's kicking in. If we were to go, look at that on a daily time frame, we can actually see, based off what we're looking at here, where the market got overextended down, 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 boom, and it's currently down, down, down. But the oscillator is thus far diverging. It's currently reading much higher than it was before, even though prices are still going down. And we'd watch for this to kind of give us an extension, if we see it dip below again, telling us that it's currently oversold. But we want to see more than anything when support forms here. If we see it higher, that oscillator divergence is a very good sign of a top. And here's an example of oscillator kind of coinciding with that. That gives us a good idea. Or here's a really good example. The bottom of this candle, this drop, 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 boom, measures way out of the Richter scale, and then it comes and consolidates and then drops again, boom, but barely measures over. So you can see that the first drop was much harder than the second drop, and we like to see that, that's a divergence in general on the oscillator. So that could be a very good strong sign at the bottom, and we could actually look at that over here. Do we get that same condition? So we can actually say, well, it's down, 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 and it's trading at support. Well, is it ready to reverse? It's trading at support. Is it going to reverse up? And in dropping down to a smaller time frame, again, we could drop that price frame back down to, say, 10 days, 30 minutes. And now we can see that, and if maybe we change to an hourly time frame, you can kind of see, I can see the oscillator giving us the divergent signal here at this point in time, even though it's still kind of, and here you got the flag, but it's kind of measuring higher. So we'd have to say this one's still measured down. Boom, 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 a lot of downward momentum. And if we could change time frames, you can measure it 1,000 times. You can go look at like 1 hour, and that's what we'd be looking for. Is again the bottoms creeping up, giving us a more solid sign of a bottom. Well, okay, for what it's worth on a 1 hour time frame, but in the context of trading at the known support from the daily chart, maybe it is finding some strength. So it's measuring kind of the downward momentum and pressure and telling you if it's overextended, and really what it's helping us confirm is slowing momentum. And you can use this on any time frame, on a daily time frame, on an hourly time frame. It's a revision to the mean strategy. It would help you to know when we could anticipate possible changes, and it's just more of a second opinion on whether or not that momentum's slowing down. So we could take this out again onto any stock, and we go say, okay, well, let's go look at Apple. And Apple is slowing down, 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 down. So then we go look at Apple with the moving average on it and go hit it on a daily time frame here. Whoops, weekly, we want to go daily. And look at it from that, well, even weekly was actually an interesting perspective. If we go back to the weekly, you can actually see, I just happened to see that as we were leaving the chart. You look at the market running down, 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 riding the band, and it says, yeah, you're a little overextended. Down, 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 outside of the band on the weekly time frame. It also tells, here's a divergence, textbook divergence of, running up, boom, next hit, boom, next hit, boom, dropped even better. Whew. So all three, lower, 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 divergence. So that's what we'd be looking for, is oscillator divergence. So here on the weekly time frame, we're oversold on the weekly and outside the band. So then we go into the daily time frame, and we see prices are consolidating, slowing down in here, and we see oscillator divergence. That's just confirming the slowdown. Now, whether it runs up or down, of course, hard to say, but we could then take that even lower and say, well, let's go look at that down intraday and just kind of get a second opinion on the measurement. And we can go down and look, 4-hour time frame. And here I can see a pretty clear divergence on the indicator. But they're still registering a little bit hard, not they're higher, but they're still kind of coming down. So here this could be interpreted as a descending triangle, or it could be interpreted as a triple bottom if it breaks out. So you just kind of have to watch that. And again, you're just using the better part of your brain to understand the momentum. Is it slowing down, and is it overextended? That's when you see revision to the mean. So that's what, I wanted to give you that lesson to kind of put that into context and give that to you to work with on the S&P or on any individual stock. And so when I look at the market right now and I'm on that S&P and we're looking at the Bollinger Band combo and understanding what it's doing on that, daily time frame, where are we? Well, we are slowing down. We could be looking at oscillator divergence. It can break and run down, and that would extend lower. So if you actually see it getting lower, well, that's a sign of strong downward momentum. So if you see it extending lower, 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 that's saying, hit, hit, hit. It's showing increasing momentum. But when it's divergent, decreasing momentum, and it slows down before it turns. So here I see the market slowing down. Could be an inverted cup and handle or head and shoulders. And it can break, boom, and it can drop. And, from the weekly perspective, out here on, big weekly time frame, you can see where it has, violated its trend, and it's sitting here with a big M, so it can go either way, but it could be the kind where, we see an M type top and then it takes off again. That was not super close, but you can kind of see it in here where you get M, rip. It's not uncommon to see the M and then the rip. In the big context, I think it's really slowing down out here, boom, boom, boom. And that could be your, 2-wave count, and then it runs. But we'll have to keep an eye on it. Now, it's, if you kind of look at historical chops and whatnot, when we start to see that first lower high, boom, lower high, boom, first lower high, that's a warning sign. And for murder, that's a warning sign. So if this breaks, go bears, boom. I actually think it'll run hard. But then you could use the same revision to the mean using the Bollinger Bands and the RSI to help you understand if it runs down, 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 when it's going to revert back up. Or if it does turn and break up, then we can know when it's done going up and looking forward to go back down using that oscillator divergence and on an RSI and a Bollinger Band. And you can use this on anything, stocks, options, futures, and Forex. And at the same point in time, see what the market's doing. So hopefully you can kind of get the broad market overview. Keep your eye on the economic calendar, and we'll catch you all in the clubhouse.
Isn't it time you got off the sidelines and tackled trading? Join our online community of active traders where we make it happen every day. Stocks, options, futures, and Forex at www.tackletrading.com. Get in the game.